or all in the US. So I decided at that point, well, okay, my income is fixed, so for the moment at least, what else can I do? So I went out there and started to become a student of wealth. I started to read book after book and audios and programs, and so what else can I do to generate wealth? And throughout all of this research, a common theme kept coming up. Real estate, real estate, real estate. It didn't matter what wealth book in general I read, there was always some sort of real estate component in there. So I decided, hey, you know what? That's the business for me. That's the thing I'm going to do. So I went out and I went to a 2-hour evening seminar, and who's been to one of those? Yeah, okay, this won't be like that, I promise. And then I went to one of those 2-day weekends, and I learned all the real estate strategies there were. There was so many of them, so I got really excited. And I just ran out there into the woods with no additional training and started doing real estate. And I learned a lot of things the hard way over that process. I can tell you it wasn't fast, it wasn't efficient, and it certainly wasn't cheap, because learning things the hard way tends to be very expensive. Would you agree?
Yes.
Okay. So, since that time, a lot's transpired since then. I've averaged over $1 million of transactions in real estate every year. I've been featured on CBC News, expert columnist now for Business Edge magazine, Global TV. They asked me about what the market's doing in foreclosures. Involved in a number of books. Now I do a lot of public speaking. I won Investor of the Year the second year in business in 2012. And I've done projects over $125,000. Those are the home runs for sure. And I've spent since then, and this is the thing that's most important on this list, is I've constantly invested in my education. Because I learned real estate fairly quick. That's a very small piece of the puzzle, but it was everything else that I didn't know coming from an engineer's background in the corporate world. Sales skills, marketing skills, how to hire a team, how to find the right contractors, how to vet people, how to look at contracts and make sure that those contractors are to be accountable when I'm not watching them. All this other stuff is what I learned over the balance of the last 7 years. Through masterminds, other seminars, more books and more training and direct one-on-one coaching. So that $100,000 spend and very much time, and that $100,000, most of it's been in the last couple of years. I was a little bit slow on the uptake in the beginning. I thought, oh, I'll figure it out. As an engineer, we're kind of wired that way. How hard can it be? I'll figure it out on my own. So a lot of that additional training is accelerated by success, because that's what I've done in the last short period of time, the last 1.5 to 2 years. So I was blessed and fortunate enough to be able to walk away from my corporate job back in 2016. And now I work full-time in business and full-time in real estate. And I also have market investments as well. So who in this room would like to get there, to get out of their 9 to 5? By show of hands. Most of you. Okay, great. And who wants to, they love their job, they're good with that, they just want to have extra income? By show of hands. Dude. Man, but you're entrepreneur, Gil. So, since then, I've come a long way, and we've grown the company, the Phoenix, that's why it's Phoenix Group, not just Phoenix Real Estate Investing anymore. We now have 5 companies, 13 different divisions in a variety of businesses and verticals. So these are some of the people. Recently, I was fortunate enough to go to a conference in LA and learn from these experts. Jack Canfield, Patty Aubrey, Kevin Harrington, amazing gentleman. He speaks really fast, but he's definitely got good content, because you always have to be learning. And James Malinchak, public speaker, talks about the business side of speaking. One of the best people you could ever get trained by. If you ever have a chance to go to one of his events, highly recommend it. So the 3 pillars of wealth. So what is wealth anyways? I'd like to get a couple definitions from people in the crowd. So what's wealth? What's it mean to you?
Freedom.
Independence.
Freedom, independence. Who else? If you can raise your hand, stand up so everybody can hear you.
Basically, having an abundant life of things you want to do when you want to do them.
Beautiful. Thanks, Rick. Give Rick a round of applause. I'd like to give one more. One more.
Just have a passion that you can follow and devote your life and your time to something with a little bit more meaning and just kind of
So a bit more meaning. Excellent. What was your name?
Tim.
Thank you, Tim. Give Tim a round of applause. So, what wealth means to me is the following. So this is what wealth means to me. Wealth is freedom, you nailed that one. It's to be able to do what you want, when you want, with who you want, plus impact. And then after impact comes legacy. So what I mean by impact is what Tim alluded to there. It's the difference you want to make in the world, the thing you're passionate about. What do you want to change? Who do you want to help? Right? Is it Habitat for Humanity? Is it the SPCA? Whatever it is for you while you're here. And then legacy can be your children, but what happens after your children and your children's children? Think of the Rockefellers. Think of Dale Carnegie. They've created a system and a foundation where their impact that they had while they were alive has continued for years and years and years after they're gone. So who's like that? By show of hands. I think everybody would. Because once you've got this nailed, once you've got freedom handled, this is what really matters to people. This is where you're really trying to get to. Does that make sense?
Yeah.
Awesome. So during all that research I did, I found two key themes through all that stuff. Now, those people I profiled, I researched certain people, how they became successful, like Carnegie and Rockefeller and some of these people. Who's read the book Think and Grow Rich by show of hands? Oh, what happy. So one of the common themes that I found in there is that they invested in three main areas. Real estate was through all of them, without exception. But businesses, think Microsoft, they're pretty successful, right? Think Amazon. That's a way you can become extremely wealthy, have a big impact. Jeff Bezos now is like in the top 3 after Amazon stock went over $1,000. And then the markets. We've all heard of Warren Buffett, yes? So I think he's done pretty well, and stock trading being the market investments, that's the third pillar of wealth. And the second key that I found was wealthy people have on average 7 or more, some less, but most of them more, streams of income. So who has 7 streams of income today? Show of hands. Nobody. So we've got some work to do. That's awesome. I'm not there yet either. I'm about 5 of them at the moment, streams of income. Some of them active, some of them passive. So let's be clear that all those 7 streams of income that those highly successful top achievers got to, it wasn't all in rental properties. It wasn't all just passive businesses where they never had to go and check on them and look at them. Some of it's active through consulting or speaking and other types of things. But 7 streams of income was definitely a key. So I've only found a few ways really to make money in real estate. There's only a few distinct ways. There's a lot of ways to get to that outcome, a lot of different strategies and things you can do to get creative. But there aren't really 7 distinct streams of income in real estate. They all kind of boil down to these 3 things. Forced appreciation, you're talking development, you're talking renovations, forcing the value of that property to be high. And then cash flow, commercial or residential. And then lastly, lease option or rent to own. I wish they would have asked me before they named the same strategy, 2 different things, but it's the same, lease option or rent to own. That's the third way you really make money in real estate. So, who's heard the phrase, by show of hands, that the rich keep getting richer? Yeah, I think we've all heard that somewhere. And it's a bit cliche, to be certain, but there is some truth to it, and that's the reason why, is these 7 streams of income. Because it doesn't matter what the economy's doing, whether it's up, down, sideways. If you have 7 streams of income in 7 different areas of the world, then something you've got is always doing well. Does that make sense? Does that make sense?
Yes.
Yeah. Perfect. Give us somebody a high five and say that makes sense. So a good gentleman that I know, very successful trainer, named Jay Fizette, he really framed this the best way. He said, don't make the wheel any rounder. The wheel is okay. It's engineered just fine the way it is. And what he means to say there is that there's a system that highly successful people have used in the past to become successful. If you follow and model that system, you will get the same results over a long enough period of time. Does that make sense? Yes. Perfect. So please, follow the system. Don't make the wheel any rounder. So the first area we're going to talk about is business. So over the last year, I found that you can do the same thing in a business that you can in real estate. I love going to find a piece of real estate that's undervalued, that's distressed, solve that situation, increase value, and then create a profit. You can do the exact same thing with businesses. You can find a distressed business where it's got poor management, bad systems, low sales, no inventory control, or no systems at all sometimes. And that owner is stressed. They want out, they're about to go under, or maybe they are just sick of it. Just like an apartment building owner that's bleeding cash because their rents are low and their building is not maintained. So you can take those same set of skills and increase income, put better management in place, put better systems in place for the business, and then you can refinance that business and keep it for cash flow, like you would an apartment building after you do a renovation if you like the numbers, or sell that asset for a profit. And that's one of the things I've realized over the last little while. And over the last year, real estate has been a little bit difficult here in Calgary to find a deal worth doing. And Mike Sherrard's been instrumental over the last couple of months to help us find deals in Calgary because it's been a tough space to do a lot of the strategies in real estate. It's been difficult. So we started to look elsewhere. And into other markets such as Edmonton for our real estate projects. Slides aren't matching. So we really started to look at other markets. We built a team in Edmonton because the fundamentals in Edmonton are very different than Calgary. Prices are a lot lower, more properties are moving there, and buyer sentiment is different. So we focus a lot of our efforts up there. And because it's been difficult to do real estate, we've really started looking at a lot of businesses recently. So here's some of the things we're looking at. We're opening up a car dealership here in Calgary, used car dealership. We're working through our due diligence right now. We made an offer on an auto shop to support that business. And we're also looking at a daycare business, an associate of mine, at a very successful company. This is a reason a business gets sold sometimes as well. This gentleman, very profitable, ran this business for 8 years. He's bored. He wants to do something else. He wants to go do it again. He wants to build another business and get back to that same hustle that he had in the beginning to build something else. So he wants to sell that business, and we're looking at that. Another gentleman I know here in Calgary who would like to own their own real estate brokerage by show of hands one day. One of you. Fair enough. Not really my thing either, to be frank, but we're looking at it with partners. And that's the thing. You don't like the business directly, but you can invest in that business and profit from it. Does that make sense? Does that make sense?
Yes.
Beautiful. I want to open your mind, shift your perspective. These are some of the things we're looking at here in Calgary. So once a business has been set up correctly, it's running smooth, has good systems, has good people in place, then it can create massive cash flow for the ownership. Massive cash flow for those partners. And compared with the cash flow you can get from a business, with the amount of dollars you have to put into it, versus what you have to put into real estate to get that same passive income, can be significantly less. Who would like to put in less money and get more money out? By show of hands. Fantastic. So, businesses also have unique challenges, of course, to get them there. Staffing, inventory, creating better systems. If you don't know that vertical, how would you put a better system in place if you don't know the business, right? You have to bring in an expert. How do you do that? How do you make sure that expert's going to help you out and work with your best interests? And how do you increase gross margins? What is a gross margin? If you've never thought about that coming from the employment world. So to refinance a business tends to be a little bit easier, just the way the banks work, because they go strictly on income. So if you take a business that has $5,000 a month in income, you increase that to $15,000, you can get that business reappraised, bring that to the bank, and they'll say, yeah, makes sense. And they'll be able to refinance that business and let you pull out a significant amount of the capital. You can get 100% business financing through some government programs. Can't do that with real estate very often. And you can normally do 90% financing on a business. So it's easier to get the financial instruments to work. There's a lot less interpretation in how they're valued. Does that make sense so far?
Yes.
Great. So we discuss, so who knows what a cap rate is in real estate? Okay, what have you. So we'll go over real quick. So capitalization rate is what cap rate stands for. And it's very, very simply the net income of a real estate asset, apartment buildings typically in commercial real estate, divided by the price you pay as a percentage. So that's a performance based on income approach. And they do the same thing with businesses. So it's very similar to a cap rate versus income, gross sales. And the other factor is when you want to sell a business, unlike real estate, they normally sell for a multiple based on their income. So if you have $1 million business in a certain industry, it'll sell for 2-3 times as an example. That's how businesses are valued. So it's pretty easy to understand how much cash you're going to get once you get that income to a certain place, if you're able to sell that business on the market. You follow?
Yes.
Beautiful. So we discussed turnkey investments in a business sense with our clients when we sit down one-on-one for those strategy sessions. And business investments are second most likely to create wealth. Real estate is number one, businesses are number two, and market investments are close third. So that's what we're going to talk about next, is the markets. So everybody's heard of Warren Buffett. I would say he qualifies pretty soundly into our wealth category. Would you agree? Last time I checked, he's in the top three, about $87 billion is his net worth. I just looked at it last night. Maybe Forbes is wrong, but arguably he's always in the top three. So he's done fairly well. And the way he's done that is market investments. That's things like value investing. Warren Buffett's thing, he likes to buy and hold stocks in a good company, goes up over time. That's why he's done very well for his shareholders. He's never been a fan, Warren Buffett, of stock trading, like doing the day trading thing, buying low, selling high through the course of the day, riding the waves of the market. But that's one way people do extremely well. Stockbrokers, hedge fund people, and then there's derivatives. So that's a fancy financial term for creative stock trading, is what I'll call it, rather than making it really complicated. I learned how to do options trading, and I've done a little bit of futures trading, and there's commodities. They trade gold and silver on the market. But the reality is you don't really own the gold or silver bar, and I'll get more into that in a second. And a hot topic of today, cryptocurrency, it's a market investment. And people are doing really great things in it, and it's certainly a new technology. With anything new, you really have to do your research, develop a system around it to make sure that you're going to be successful on a consistent basis. And then foreign exchange. So that's just simply buying US dollars now, waiting until it goes up, selling it later. And there's also options, derivatives can be traded on currencies as well. So does that make sense so far? There's a few different types of market investments.
Yes.
Great. So it's the fastest way to create wealth. It is the riskiest for sure, but it is the fastest. Look at an IPO. Look at Amazon. Look at Facebook. Look at all these tech companies. Their multiple is like 78 times their income, which is insane. That doesn't make any sense. That company could go under tomorrow. So, but it can happen very fast. That is the fastest way to make wealth for sure. It's not tied to a real asset though. So even if you have stock in a company where you own 0.03% of that gold bar, that company does not have a safe that has a gold bar with lines on it that has your 0.03 share on it. That company could go under, and then your investment could go to zero. That's a fact. It's a reality of the markets. There's no intrinsic asset. So they could go to zero. However, there are systems investors can put in place to make them money over the long term. And factors beyond your control. War could break out, a flood could happen, that could greatly affect your investment. CEO could be caught stealing money, and then the stock price crashes overnight. So all these things can happen, and investing in the markets traditionally has been very limited to what the banks are willing to give you. And the bank, here's the secret, they're not on your side. They'll never tell you that. But they charge huge commissions to bring your money in, and they charge a management fee no matter what, whether your investment goes up, goes down, or sideways. That's their model. So their goals are over here, and yours are way over here, making money. Does that make sense? And in addition to that, traditionally, to have an actively managed investment, which is what you need to do in the markets, you have to watch the charts, you have to be involved, you have to put in the time to manage it actively. That if you walk into a bank and say, I want a portfolio manager to manage my stocks and pick them and do that for me, they'll say, yes, we'll do that for you, we'll get Joe on it right away, please sign here for $1 million. That's typically the minimum. I used to work for banks in the telecom world, and that's their wealth department's typical barrier to entry. So that's a pretty high barrier to entry, would you agree?
Yeah.
No offense. And the reality is, most of those professional brokers are going to lose money over their career. If you average all their portfolios, all their clients, more often than not, in a 25-year period, they're going to lose more money for their clients than they will make. Some are going to be astronomical successes, most are going to be average, and then some are going to lose money. But overall, they're not making money for their clients. I'm not giving brokers hard times. They do the best they can, and some of them do an incredible job. But if you average their industry out, they don't perform very well. There was actually an experiment done, since the 60s, they've done this every few years, where they've taken the New York Stock Exchange list of stocks, and they had monkeys throw darts in it. Okay? So that created what's called the monkey portfolio. Okay? So then they compared the monkey portfolio to groups of these pro professionals that are supposed to be managing the money, and they compared the two. And the result, resoundingly, was, not by a double or anything like this, but significantly always, they do it every year, since '64, read this article, you can Google it, read the article on Forbes, that the monkey portfolio outperformed the professionals. Love it, I love it. So, now, and I'm being a little bit funny here, but the end result was then basically saying the following, is that if you're going to be in the market, because of the overall risk with a lot of things, that here's the market, right? It goes up and down, and it bounces around, and like this. But over a long time scale, this is time, it always goes up. And that's true, right? That's a true fact. So, what the ultimate recommendation from this monkey portfolio versus professional portfolio was, if you invest in something called an index fund, you're basically trading the whole stock market. Because that will always outperform picking individual stocks, whether they're professional or they're monkey short terms. Make sense? Okay. And again, some portfolio managers do a great job. So that's kind of the traditional way of looking at the markets. Let's talk about index funds. So I currently do invest in the markets, and it's about 20% of what I do. 80% is the balance of my investments are split between real estate and business. So I do invest money in the markets. So all highly successful people that I research and profile, they all have some money in the markets. Even Bill Gates and Warren Buffett have become great friends because Warren Buffett taught Bill about the markets because he's a business guy. And Bill taught Warren Buffett about technology because he hated anything he didn't understand, right? If it wasn't power or grain or insurance, something like that he understood. No, I don't want to invest in things I don't understand. And he missed the dot-com boom and all these things because he never wanted to invest in anything technology, but then Bill has taught Warren about technology and technology companies. And now he's invested in those companies, Microsoft, obviously being a blue chip. Now it's definitely Warren's style. It wasn't when they first met him, it's still a little company that built with him. But all of these highly successful people have money in the markets. Some more than others, depending on their experience and depending on their comfort level. But one of the main benefits to market investments is they're more liquid than the other two. A business you can't just sell overnight. Maybe you can sell assets, or maybe you can get a loan or refinance, but it's a tough asset class to get capital out quick, so you want to capitalize on opportunity. And real estate, same thing. You can't just necessarily take a house, sell it tomorrow, and get an offer the same day if you need to take some of that equity out to make another investment, or something unforeseen happens. Does that make sense? So market investments are the most liquid, and it's a good wealth practice to have some capital available to be able to jump in on opportunities that make sense for you, make sense for your growth plans. But it's way better to have that money that you want to keep liquid in a market-based investment as opposed to sitting on your mattress or sitting in a bank collecting 0.25%. It's actually losing money. It's actually going down because inflation is defeating your dollar every day. Does that make sense? Perfect. So now, real estate, which is my personal favorite pillar of wealth because that's where I started. Also the most reliable. Every single one of these highly successful people are involved in real estate. Just think about it for a minute. Would you rather be an owner or a tenant? Owner, show of hands? No. And tenant, show of hands? Okay, that's fine. Now, these big businesses understand way better to be a commercial landlord than a commercial tenant. So Microsoft owns many of the buildings that they have. Google's campus in Southern California, they own those buildings. They built those buildings. They don't pay rent. They do in some cases, but they realize that it's a benefit to be the owner, not the tenant. So they're in real estate. And Warren Buffett came on CNBC and said, if I had the manpower, I would right now, right after the crash, about 2 years after the crash, go buy 1,000 residential homes in the United States of America. And he's a stock guy. So what's going on with that? It caused a lot of interesting circumstances. Now Wall Street's like, wait a minute. Warren Buffett's talking about real estate. Good grief, we gotta go and buy us some real estate. So So they did that, and they started driving rents down and prices up in really appealing markets like Florida and Phoenix and things like this. So all highly successful people are definitely invested in real estate. The most reliable way to create wealth, because over a long enough period of time, everybody's heard real estate average doubles every 10 years, correct, by show of hands? Most everybody. And it's very forgiving over the long term. That even if you make a mistake in real estate and you have a long enough time horizon, those mistakes can wash themselves out over a long period of time. So it's very forgiving if you have a long time scale. And it's the least likely to go to zero. Even if you had to sell the real estate at a loss, you can get some of that capital back. It's extremely rare that you're going to lose all your money in real estate if you have a long enough period to wait. If you come in a hurry, that risk gets a lot better. It gets a lot higher. Which is the most important thing in investing is capital preservation. I'm going to go over an example to see what you guys think. So, let's say an investment is targeted to make 30%. Who'd like 30% return by show of hands? Great. So what if it only made 20? Would we still be happy by show of hands? Yeah, everybody. Okay. What if it only made 3%? Are we still happy?
Yeah, depending on the volume.
Depending on the volume, great point. But we didn't lose anything here, right? And option C, lost some money but not all. Who's happy about that? Nobody's happy now. Okay. And then of course D is our nightmare scenario, we've lost everything. So real estate is the best vehicle for capital preservation. It's the least likely to wind you up in option D. You follow? Okay, great. That's why it's the most consistent wealth generator, because you don't very often lose all your money overnight like you do in the real estate market. However, major corrections can happen, which is why diversity is important. So one of the reasons I was really attracted to real estate when I was doing all my research is that there's many ways to make money in real estate, many ways to get to that outcome, to capture those three strategies. And I've learned over the course of almost 8 years now in the spring that most of those strategies aren't very fast. I always say to my clients that, despite what they see on TV, that real estate isn't get rich quick, it's get very rich very slow. Okay? Does that make sense? Perfect. So traditionally, and like I said before, if you're in a hurry in real estate, and I made this mistake, if you're in a hurry, your risk profile goes way up. If you have to sell quick, if you have to pay investors back, then that can become problematic. And traditionally, it has a very high barrier to entry. In Calgary, as an example, what's the average price of a house right now, Mike?
Like 470, 480.
470, 480. About $100,000 to put that 20% down. But that's not where it stops if you're going to turn real estate. Then you need project capital. You need the money to renovate the property, you need the money to hold it, you need legal fees. Let's just call that $50,000 as a round number. So now you need $150,000. Plus, passive income for real estate does require a level of credit as well. And it takes a large amount of your capital, and it parks it for a very long period of time. It's not liquid anymore, it's got to stay there to generate that income. So to do 5 projects in Calgary, you roughly need about $500,000 using that 150 example. That's a pretty high barrier to entry, isn't it? Would you agree? You'll be able to do 5 projects in a year. So how do you overcome that hurdle? And that's one of the things we show people through our creative programs. And passive income. So the key component to building wealth is getting as many of those cash flowing assets, businesses, rental properties, as you can. But the other thing is that the more important thing is to get them fast, right? How do you get a lot of those cash flowing assets, producing that passive income for you in a hurry? So I'm going to go over a concept called the time velocity of money. Who's ever heard of this before? A show of hands. My clients, of course. So a few of you. So this is how many times you can turn your capital. Think of it like going to a grocery store, right? If you have a grocery store with a can of peas sitting on the shelf, can you picture it? Can you see the can of peas? Mm-hmm. Great. So we want to take that can of peas, have someone come in and buy it, we replenish it, have somebody else come in and buy another can of peas. We want to turn that inventory as fast as possible. So the same thing is true of your capital. You have to treat your capital like your inventory. You want to be able to turn that as fast as you can, to get as many turns as you can in a 12-month period, because that accelerates your growth. It always accelerates the growth of your capital. And I always suggest a two-pronged approach. You have to be buying those cash flowing assets, but you also have to be growing your capital base, so that you can capitalize on those opportunities when you see an asset you like. Does that make sense?
Yeah.
Awesome. And the faster turns you can get gives you more capital, so you can take down those cash flowing assets. So 2 foundational ways. I mentioned lease option, but it's really just a way to get cash flow and force appreciation in the end. That's why I made this short into 2. Multiple ways to get there. We're going to go over 2 of them. Now, we're going to talk about no money down, low money down real estate. Who likes the principle of not being able to use any money taken on a property? By show of hands. Yeah, that's my crowd, absolutely. Because here's the old way, right? You've got your 20% down, you got your banks, and you've got something called cap space, which most people don't talk about. Certainly the banks will never tell you. Who knows what cap space is? By show of hands. A couple, so just 2. So I'll go over really quick. What the banks won't tell you is that based on your income, your credit, and type of job you have, whether you're a wage earner versus a self-employed person, they're going to put your information into a calculation to give you your debt ratio and all that stuff. And then they're going to put that into another calculation, which they're not going to tell you about. And it's called cap space. And what cap space means is TD Bank, RBC, Scotia, all the big 5, they have their own little criteria that says Brad can only have 3 mortgages with me based on his calculation that my computer spit out. And that Brianne can only have 3 with Scotiabank. And then ATB will only give you 2. So this causes a problem with scale. It doesn't matter at a certain point how much money you make. It doesn't matter at a certain point whether your credit score is a 900 or 899. The banks are just going to say, no, you're going to hit the brick wall of finance. That's going to happen to everybody at a certain point in time. And this is the solution. Terms deals is what I call them. And there's a few different categories. We're going to go over the one at the top here, agreement for sale in detail. There's also seller financing, wrap mortgages. There's a few ways, again, to create these outcomes. What I love about real estate, my engineering mind just gets in there and says, how can we structure this, create a win for the client, and make it easier on us? So this is the strategy where you're controlling the property. You're what? The property? Right, and you don't have to. And you don't have to. Perfect. And this is how you get scale in this business, is doing it this way. So this works really well for motivated sellers, right? You've got your death, divorce, taxes, downsizing due to job loss, hundreds of other reasons. Empty nesters just want to sell, estate sales. I've got great deals from estate sales, even on MLS, right place, right time, knew the community, went in and saw the property. Wow, this is way undervalued. I saw a house 3 months ago, it was 125 grand more than this. Boom, put the offer in. Those are situations where somebody will give you these terms deals. And there's many, many of these circumstances, and Blake will know, there's lots of them that he talks to owners all the time. So what happens here, I missed something.